Happy Thursday. I'm Jeremy Andrus, CEO of Trader Grills. Welcome to our SMB series. We've now been doing this for, I believe this is our 7th week. We started with the PPP loan program. That was actually our first 2 programs, our first 2 segments that we did, and we're back to talk about loan forgiveness. This has been at least in the state of Utah, we have fared well. We have earned more than our fair share of PPP loan funds. And we did an earlier segment on forgiveness. We did our best to address that topic, but it was early in the program. It has evolved. We have learned a lot, and we're going to get pretty down and dirty and detailed into the program around forgiveness and what we know. I want to introduce the moderator and the panel. Stephen Brown is the moderator. Stephen is co-founder and COO of Ledger Gurus. Stephen has been a fixture on the Silicon Slopes Economic Impact Committee. He has provided a tremendous amount of value. We're very grateful for the work that he's done, generally speaking, and in preparation for the panel discussion this evening. Shane Edwards is a partner at Squire, the fastest growing accounting and business consulting firm in Utah. Shane has also contributed a lot to the business ecosystem as we've gone through this moment in time, and to the work that we've done as a committee as well. Thank you for joining us, Shane. We've got Brent Beardall. Brent was also on an earlier panel. Brent is the president and CEO of WaFd Bank, which is headquartered in Seattle. He joined WaFd in 2001, served as CFO from 2003 to 2006, and is currently president and CEO with a local presence here in Utah. And lastly, a familiar face, Mark Andrus. If I don't see him enough, I get to see him this evening. Mark, thanks for joining. Mark is an advisory manager at Squire & Company. He provides CFO and controller services to small and medium-sized businesses across the country. Thanks for joining us, and to the panel, thank you. And I will turn the time over to Stephen. Look forward to a great discussion this evening. Stephen.
Awesome. So what we want to talk about today is the Paycheck Protection Program forgiveness application, and it is deep. But before we dive in, we want to give a couple of high-level or general updates on the program, because so much has changed. It's changing week to week, almost day to day. A couple of things to note. Here in Utah, there have been 47,000 loans, just over $5 billion total, which represents about 1%. One of the things that we'd like to challenge the audience is, if you haven't got your loan, there's clearly a lot of small businesses that have not. And we would not only say go get your loan, but encourage your favorite small business, whoever that is, to go get their loan as well. Even though Utah's done reasonably well, there's a lot that still need their loans. We've done a little bit of research, and there are a number of banks that are still taking new loan applications, including Brent's bank, WaFd. Our experience talking to Shane Edwards, what we're seeing is the big banks, it's kind of a roll of the dice. The fintechs are good at volume, but we've seen that if you have some bumps with your application, that sometimes that can be a problem. And that the smaller banks are actually providing some of the best service. So there's a lot of options. We don't have a comprehensive list. This is a list that we reached out and tried to get some poll information. Other things to note are some changes. There's a lot of changes that are being discussed. There's actually an act, the Paycheck Protection Program Flexibility Act, that is being discussed, as well as some bigger acts that might incorporate some of these things. Some key changes that are being discussed. extending the forgiveness period beyond 8 weeks. So right now it is an 8-week period from the time you get your loan, or there is a little bit of a flexibility in the start date. We'll talk about that. There's discussions on making the forgivable spend tax deductible. Right now it is not. There is discussions around flexibility on spending. For example, a business being able to spend on PPE to get back to business, changing the spending limits. The one thing that we would note is the general tone is towards more flexibility. But until it's law or regulation, it's just speculation. So don't, Shane, let me ask you a question real quick. I think you and I are on the same page here, but what our general opinion, my opinion at the beginning of this program has shifted. And I would generally say, like, don't spend the money unless it makes sense to spend the money, regardless of whether it's going to be forgiven or not. What's your take there?
Yeah, I think a common sense approach, similar to how we go about protecting ourselves from the virus itself, very, very, again, commonsensical. And if it makes sense for our business, let's take the loan. And if worst case scenario is not forgiven, we have a 1% loan with a relatively long payoff period of 2 years.
Couple of other things that are known. So the Department of Treasury is providing FAQs that are providing guidance around the program, and these come out at least once or twice a week. For a period, it was almost every day. Some things to note. There was a lot of emphasis on certification of the need. There's a statement in the application that says you certify that you need the loan, but they haven't really expounded upon that. They have said things like public companies and well-funded private companies probably shouldn't have that if you have adequate sources of liquidity. They haven't really defined what that adequate sources of liquidity is. And we feel like there's been a cooling effect with some of the conversations with the public demonization of, sometimes legitimate demonization of companies that got the loan. There is liberal interpretation here. The other thing to think about is your audit likeliness. They came out with a pretty strong guidance last week that said, if you're under 2 million in loans, you're probably not going to get audited. They wasn't that explicit, but Shane and Brent, from your interpretation, what I read was, if your loan is less than $2 million, you're honest in your self-certification, you're probably going to be okay.
Yeah, I think initially it was the messaging was, if you're under 2 million, we're not going to poke and assess your certification relating to need. And I think we're all hopeful that translates into a minimal, if non-audit factor for those that have less than a $2 million loan.
Yeah, and if I could jump in on that one, I actually give the SBA a great deal of credit on this one, because this was causing a lot of consternation among PPP recipients. What does it mean to have the need? Does that mean that you need to drain all of your bank accounts and all your owners' bank accounts before you can certify a need? So we view the guidance the SBA put out as, it is now clear, if you received a PPP loan of 2 million or less, the presumption is you had a need, so you don't need to worry about that certification. Now, there may be some of you on this call who were over $2 million, and what does that mean? And I think you need to advise closely with your counsel and your accountants. It does not mean you need to return the PPP funds, but I think having a clear documentation trail that you considered whether you needed it and you made a determination that there was a legitimate need for the funds and why, and that may include stress testing, it may include projections, but having a clear documentation threshold or documentation trail that you can show, you need to presume you will be audited if you're over $2 million. So talk to your professionals now. Don't wait until such time that you are audited.
Awesome. Other things that we've heard, and I'm just pulling out some key ones, is the start of the forgiveness period. There is a little bit of flexibility there. We'll talk about this. This is outlined in the forgiveness application. Initially, it was the day that you got your money, but there is a little bit of flexibility that has been communicated. There's obviously discussion of more flexibility. The big one that has unfortunately had a chilling effect as well is that the IRS will not allow any expenses that have been forgiven to be tax deductible. I am hopeful, I'm optimistic that this will change. They'll need probably some legislation to get this to change. But just note that at the end of the year, you may have a slightly higher tax burden, not because it was treated as income, but because those expenses will not be allowed to be deducted. And there's a lot more. We're going to try and answer as many questions. One other thing before we dive into the application and some of the questions. Now, I do have one question about the safe harbor for under $2 million. Essentially, the guidance was, it hasn't been this explicit, but it essentially says if your loan is less than $2 million, you're probably not going to get audited. They're going to trust that you're self-certified. They didn't go that explicit, but they went up almost right to the line to say that with the language that said we're not going to poke the less than $2 million loans.
Well, if you just look at the number of loans that are over 2 million, I'm just looking for the exact number, but I mean, what, 50, 60 plus thousand loans, if they're going to even try, if the SBA is even going to make an attempt to audit every loan over 2 million, that's fundamentally impractical.
Yeah, they'll have their hands full.
Yeah, I think they have plenty to do. My guess is that they probably won't even get to all of those that have a $2 million plus loan.
But one of the key points here, even if you're below $2 million, I think everybody needs to go in with their eyes wide open and presume that it will be a headline in the paper that your company received a PPP loan.
That's a really great point, Brent. There's been a lot of discussion, and I think, from a negative standpoint, there's a lot of discussion around making this publicly disclosed. Mm-hmm. So I've been telling my clients, assume that everybody's going to know you got a loan, and be prepared for any ramifications of that.
Yeah, I've even gone a step further and advised our larger small businesses to prepare a press release. What does a press release look like? Take away the sensationalism that can come of a headline. Put it out there yourselves and talk about the good you did with the PPP loan, all the jobs that you were able to keep, and exactly what you used those funds for. Take the offensive. Don't just stay back and wait to be on the defensive. If you can take the offensive, I think you're much better off.
That's awesome. Thanks, Brent. One more slide, and then we're going to dive in. It seems like the whole world has focused on the PPP. There are some other programs. There's one that is starting to build some interest. Brent's got some interesting insights on this. It's a terrible name. The Main Street Lending Program. It's really, I would also say it's the kind of the mid-market lending program. This is something that's coming out of the Federal Reserve. There's going to be 3 options. It's been worked on for weeks, but they're just taking a long time to launch. The chair of the Fed got grilled by Congress the other day, and he said that they were going to have this operational in June. These are large loans, $500K to $10 million minimum based on the loan. The rates are pretty reasonable, if you ask me. It's supposed to kick off in June, but there's a lot that still hasn't settled on this. Brent, you're in the fight on the mainstream lending program. You're in the middle of this. What's your takeaway from the mainstream lending program at this point?
Yeah, I think there's 2 key points. One of the issues we had with PPP is it was first come, first served. So you had this notion that if you didn't move quickly, you were going to be left out. On the Main Street Lending Program, it appears to be appropriately sized, so there's nowhere near the rush. And then also the rules are evolving just like they have for the PPP program. But one of the key differences, the Main Street Lending Program is not just a risk that the federal government is taking, but the banks are taking as well. So when the banks make the loans, if there is a loss, if it's not repaid, then the banks are on the hook for a portion of that. And so the banks are very slow to try to roll out this program because the definition of the program has yet to be defined. For example, if one of our small businesses that owned and operated hotels and came to us, and today we would look at their financial statements and say they have no income. It would be a very poor judgment to make a new loan to a company that has no income based on COVID. And so you wouldn't want to make that loan in that scenario. If on the other hand, they said, okay, we understand we're in this pandemic environment, let's look past this. Let's look to their December quarter when they were under normal operations and make the loan based on December quarter. If we got that kind of clarity, then we could easily go and use this Main Street lending program as a way to get liquidity to companies. And as you point out, the rate at LIBOR +3 is a very attractive rate in this environment. So that's just one of the key points that we need clarity from the feds. And as banks, we're working with both the OCC, the FDIC, and the Fed to get that clarity. But it's kind of like the PPP program. The more layers of the onion you peel back, the more confused you get.
So we would encourage people to keep their eyes on this one. This is, we're seeing and hearing traditional lending drying up because of what Brent pointed out, like there's not revenue to support a traditional loan. And I think this program is going to fill in. So if you were in the process of needing to really capitalize up, this could be a good program, but there's still a lot of details that need to be sorted out. Two quick other programs I want to touch base on. EIDL is kind of dead. It's not dead, but essentially the emergency injury disaster loan, they're only taking new applications from agricultural businesses, and they are still processing applications for those who applied before April 15th. This was done directly with the SBA. So if you haven't applied, you're probably, and you're not doing agriculture, you're going to have a hard time getting in on this one. I'm going to mention this one. It's probably not relevant for this audience because if you have a PPP, you can't use it, but there is also an employee retention tax credit program if you didn't get your PPP. So for whatever reason you didn't get it or didn't want it, there's this option. I'm assuming this audience is going to get the PPP or wants to. Let's talk about that real quick and then transition. So John, we want to just do a quick poll from the audience on where you are with your PPP. It's helpful for us to know. And then we're gonna switch over to Mark and start talking through the application. So we'd love to, while we're doing this, we can maybe take a couple questions. It'd be a good time to take some questions. John or Tanner, what questions do we have that relate to some of the content we've already covered?
Yeah, Tanner, if you'll pull up that doc and read off a few of them, that would be awesome.
So we've got some questions around when an employee quits. That is it's not a trivial question. Shane, do you want to talk about that one?
Yeah, it may be better in the context of going through the forgiveness application itself and the tool that we have to help calculate those numbers, because I think we'll give a lot of clarity to that topic at that point.
Okay, yeah, we'll talk about that in context of the tool because it is in there. Okay. Yeah, I think I'm looking over some of the pre-submitted questions. There's a lot that'll probably be better to do in context of the loan program. John, do you want to do anything else that would make sense to answer right now? Or
I have one. Someone just posted that they haven't heard back from the bank that they applied to. So what should they do?
That's a great question. Our guidance, we talked about it the last time. There's no penalty in applying in multiple places. It kind of clogs up the system, but I would say at that point, if you've heard nothing from your bank, talk to somebody else. I know Brent would be happy to take that list of others. It's good to see. It looks like most people have been funded, so awesome. Okay, well let's dive in. I think a lot of the specific questions we will hit as we are going through the application. So Mark, why don't you share your screen and let's start talking through the forgiveness application. I did see some people say where can you find this application? John, are we able to send the links out on the social channels? Is that something we're able to do?
Yeah, absolutely. And we'll post to the YouTube chat right now. We posted it once before and we'll post again for the application. And any links we bring up during the conversation, we'll be sure to post as well.
Okay. So this application is public. It is, it's a bit of a beast. I'm not going to lie. The loan application wasn't terrible, but there was some nuance to the calculation. This one's a beast, and that's why we want to dive in and talk about it. We're going to skip straight to the calculation pages, not go through all of the items. Why don't we go to page 3 real quick, Mark? You know, let's go up just a little bit before we dive in. The only thing I would say here is, you know, most of this information you should have been able to pull right back off your application. Your loan docs should have the loan numbers. If they don't, you can go back to your lender. They should have those. We're going to want to talk about the employees at the time of loan application and forgiveness, and that's a separate conversation all unto itself. But let's go down to the calculations, and we're gonna probably bounce around between the application, different parts of the application, and some tools to calculate that. So, Mark, I'm gonna let you kind of run from here. You and Shane, let's go through, and we'll interject with questions and as they come up.
Well, thank you, Stephen. I'll give, Mark and I will just tag team this. There'll be a fair amount of back and forth, as Stephen mentioned, between the actual application form and some tools. And this may be a good time, John, to actually distribute the link to the tool from the American Institute of Certified Public Accountants. It's that's referred to as the AICPA. Late last night, they released a tool, and we were actually in contact with them this morning to make some amendments to their tool. So they had some adjustments. The tool is free to anybody who can find it on the site, and fortunately follows the basic outline of the loan forgiveness application itself. So today we're going to go into some fairly deep details, but the principles are relatively simple. And those principles, I think, are outlined on these 10 lines that you see in front of you. So you've heard this many times. Lines 1 through 4 are, what are the costs for which forgiveness are eligible? So you accumulate those, and then on lines 5, 6, and 7, there's an effort to reduce the amount of forgiveness for which you're eligible. And then at the end of the day, lines 8, 9, and 10 dictate how much of the loan is forgivable. So the way that the Treasury and the SBA have decided to interpret this is you get the smaller of the 3 remaining numbers. So either A, you get line 9, which you get the full loan forgiven, or line 8, you get the amount of the loan forgiven after you reduce for headcount reductions and salary and hourly wage reductions, or again, the lower amount of this current requirement, which legislatively may change, but the current requirement that you have to spend 75% of your funding on payroll-related costs. So as we go through this tool and get into some of the nitty-gritty, just if you get confused, always go back to maybe this page of the application and say, okay, this is the portion of the application that we're in now. Get your bearings, and then go back into the weeds. Perhaps with that, Mark, we're at a good point to transition to the sample company that you put together for us, and maybe start off perhaps with some payroll points.
Perfect. So one thing to note about this beast of an application is, in my opinion, it's kind of backwards where you start. So this is the main summary page, but all of this information that you see on these lines is going to get filled in from the bottom up. And so I'm gonna zoom down to the bottom here, and you'll see here we've got two tables here that we're going to start by filling out what the employees made during the 8-week period. But even before that, we're going to talk about what the employees made between January 1st and March 31st, because that's a look back period that we're going to look at with that the PPP looks at to compare how you've done in keeping your employees employed versus that period. So I'm going to switch over here to the AICPA's tool that they've given us. And the tool is actually pretty, it's very robust, and it helps you walk through each of these items. So you can start on the instructions page, which I would highly recommend if you use this. Start on the instructions page, and it tells you kind of the order that you're going to want to fill these things out. So what I would recommend is going down to the payroll accumulator. So this is where we're going to actually put in the wages for our employees during the covered period. There's a couple of things that might be helpful to fill out before you do that, and that's just the dates here. So if it's okay, I'll start first by talking about the dates of when you receive the loan and when you can put on the start date of your 8 weeks that they're looking at for the forgiveness. So the disbursement date in our sample company here is going to be the 22nd of April. And the alternative payroll covered period, and this is something new released by the SBA just recently, was they're saying, hey, for companies that have weekly and biweekly payroll, let's be flexible when that start date is, so that we're able to line up exactly to those 8 weeks and have 8 payrolls or 4 payrolls fit in the 8 weeks instead of making companies change their payroll dates. So they've introduced the alternative payroll cover date. And so you could either go back to the beginning, the first day being the first day of the pay period of which you've received the loan. So in this case, it would be on Sunday, the 19th, we could go back to, or you can fast forward to the next pay period. So in this example, we've opted to use 4/19. This company that we're doing is a bi-weekly, so they had 4 payrolls that fit neatly into the 8 weeks. And so I would fill those dates in, and then you can see it gives you these dates here that says, okay, this is what we're looking for. So what it recommends is that we run the payroll reports, and we're hoping that payroll providers get on board here, and I think they're really trying to provide some reports that help you easily ascertain the information and get access to the information that you need to fill out these reports without having to do too many gyrations. And so what they recommend is you get first quarter, so January 1st to March 31st, get your payroll information from those dates, and also get your payroll information for the 8-week period that we're looking at. And so what we're going to do is we just list out our employees, and this first section, it has you list out the employees that make under $100,000 annually. And then in another section, we'll look at the ones that make over $100,000 annually. So the first section here is for these under 100,000, and these are familiar names. We're doing Dunder Mifflin today. So just some example information that we put out. That's not really what Dwight makes, but the first thing that's going to be important is that the SBA wants you to include a 4-digit ID number, and what they recommend is the last 4 digits of the employee's social security number. So this is all information you're going to need to track and provide. For calculation purposes, we need to designate whether an employee is an hourly or salary employee. And then moving on, once we do that, we say, okay, what did they earn during Q1 of 2020? And what are the gross wages? So we'll go ahead and calculate those separately and drop those numbers onto this sheet. Everything in blue on this sheet is meant to be filled out, and everything in white is calculation that you don't need to touch. And so once we drop those in, we're going to drop in the hourly average numbers of if they're hourly, we're going to drop in the average number of hours worked per week in that quarter. So we're going to go back and find that average number of hours. And what I would suggest is putting this information on a different spreadsheet and tracking it. So I've done that in the background. We kind of have our own tool, proprietary tool for Squire. But I've gone ahead and listed out employees by pay period. So I've got 4 pay periods here that I've listed and put all their information, and then it kind of summarizes over here onto a table 1. So that's where I grabbed the information that we're going to be looking at here. Sorry, let me go back here. So we've got their hourly wages. I'm sorry, their hourly, the amount that they worked, the number of hours they worked in Q1, and then it will come up with their salary. So their hour, what's calculated is their hourly wage. And so moving over here a little bit. I've got here their wages paid. Let me start here. I forgot I did a little sample here. So let me fill this back in. Okay. And so then you're going to do for the covered period, you're going to list their wages. So we're done with the Q1. We're now going to move it to the covered period. How much did they earn during the covered period, along with their hourly amounts? And that's going to calculate, again, their hourly rate, and if their salary, their total salary amount. And this is an annualized rate for the year for anybody that's salary. So you can see what do I earn in Q1 was, I'm sorry, not Q1, the 8 weeks was equivalent to $52,000 annually, and it does that calculation for you. Now, what the next step it's going to do is say, okay, did Dwight or anybody get reduced in their payroll? And in this case, if we look back to Q1, he made the equivalent of an annual $78,000 in Q1, but we dropped him to $52,000 for the 8-week period. And so the next step that we have to fill out, it says, okay, if they have a forgiveness reduction because we dropped them more than 25% of what they were earning before COVID and before the PPP loan, before the 8-week period, then we are going to go back and see what the amount that we dropped them below the 25% is not forgivable. So they'll give you a buffer of the 25%, but then they'll say anything below that, they're going to prorate for the 8-week period, and that amount will not be forgivable. So what is looking at here, and the application does this, it's just very complicated and convoluted to figure out what's going on, why they're asking these questions. But what you have to do is you have to pull up you have to annualize their wage for a couple of different periods if they experience that 25% or more drop. You have to say, okay, if they, what was their annual salary or their hourly amount at February 15th? And just to add some context to the dates that they're using here, we're going to see February 15th is one of the dates, and that's kind of the designated, this is right before COVID started at the February 15th deadline. The next date that we're going to look at is April 26th. And the reason for that date is that's when the majority of round 1 PPP funds funded. And so that helps kind of put things in context of what they're looking at. They're trying to see, okay, what was it like before COVID? What was it like when we funded your PPP? And then what was it like at the end of the 8 weeks? And so those are the 3 time periods that we're looking at here. So he earned $78,000 at February 15th, the equivalent of, and so you know, on the February 15th, what I would do is I would take the payroll, the average amount he earned on the payroll that covers the date of February 15th. So I wouldn't get too hung up on exactly what he was earning at February 15th, but look at that payroll that encompasses February 15th. The next thing that I would do is go over here and it wants to know what his hourly equivalent annual hourly, sorry, not hourly, annual salary was for February 15th through April 26th. So that period, you can see that he dropped significantly. So that means that that we are not eligible for the safe harbor yet. And then it says, okay, now that he's dropped at June 30th, which is the designated kind of end of everybody's 8-week period. So that's why they chose June 30th, because theoretically that everybody's 8-week period would end by then. Did you restore his wages up to the 78,000? So in this instance, we did not restore his wages. So we're not eligible for the safe harbor, and the safe harbor meaning we won't get dinged in a reduction of forgiveness because we reduced his wages. So in this case, we will get dinged because we did not restore his wages up to the annual amount of 78,000 by June 30th. So moving over here, you can see that this is the actual column it uses to say what was the reduction in wages, and that was the 100,000 there. And I believe this is Angela here, also got reduced from, we'll quickly look at her. She was making $20 an hour. So everybody else was hourly. She was making $20 an hour, sorry, $30 an hour before COVID. And then we reduced her to $20 an hour, which also was below the 75%. So they're looking at their hourly rate drop there. And the equivalent of her hourly rate drop is we could have dropped her down to $22.50 an hour and that would be the 25% mark right there. So we could have dropped her down to there, but we dropped her a little bit below that down to 20. And so it's marking the $2.50 as the wage reduction, and then giving us an $800 ding for that, because that's where she ended up. We did not properly restore her wages. In this example, you can see we did make up a little bit. We got her to 27, but that's still not enough to restore her wages completely. So we still take the ding on the reduction in wages on that one.
So Mark, I want to pause you for a second.
Yes, please.
I own an accounting firm. My head already hurts, right? And
yeah, it's rough.
This is brutal, right? There's a number of questions, and I want to kind of take a step out for just a second, because this is probably overwhelming for a lot of people. It overwhelms me every time I dive into this stuff. You know, there's a lot of questions I'm seeing around. You know, maybe is there shortcuts? Let's say nobody had pay reductions. Can we take a shortcut and just, you know, skip all of this?
Yep. So let's say that nobody had any pay reductions. So let's go down to the people that are earned over 100,000. We go ahead and list those people here, and then we will. What happens is we're only able to take a forgiveness amount equal to 100,000. So what the SBA has determined is that 8-week equivalent is 15,385 is eligible for forgiveness for anybody that makes over $100,000.
So there's your cap for high earners. It's 15,385. Remember that number. Other questions, and you touched on this. I want to dive into this a little bit. There's a question around the 8-week time frame, what we're comparing against. What we have in this particular tool that the AICPA put out has put in June 30th, but we could still get PPP loans for a while. Let's just make sure we're clear. What are the 8-week periods? And Brent and Shane, feel free to jump in here. What are we comparing against? What is that baseline that we're comparing against? I just want to point that out very clearly, because there was a question there, and I want to make sure it's clearly specified. So what is the period that we are comparing our 8-week spend period against?
So first of all, to be clear, because I'm also an owner of an accounting firm, and I also have a headache. So I can only imagine what others are facing right now. But let's talk about the 8-week period. There's as Mark mentioned, there's two alternatives to begin the 8-week period. Alternative one is the day you receive the actual funding, right? So, and you actually count the day that you get the funding. So 8 weeks, that's 56 days after you received the funding. That's option one. Option two is if you're a biweekly or less payor on your pay cycle, you're allowed to use the first day of your first pay cycle to begin your 8-week period. Now, to get to your question, Stephen, on what are you comparing against, the complexity, all of this headache complexity comes in because we're trying, the SBA did not want business owners to reduce the amount of pay that they were paying people that made less than $100,000 a year. So they used as their comparative period January 1st through March 31st of 2020. So big picture, if you reduced your people's pay that made less than $100,000 equivalent a year compared to what they made during Q1 of 2020, they're going to ding you to the extent that you exceed the buffer of 25%. Mark, what would you add to that?
Yeah, they're kind of looking at two different periods, right? They're looking at an annual amount that they earned in 2019, and they are looking at that three-month period at the beginning of 2020 are two different periods that they're comparing against. And there's so many different calculations, like when you're looking at full-time equivalents, they're comparing it against a different period. I mean, it's hard to make this going through these calculations exciting and invigorating because they really are deep in the weeds. But yeah, that's the period that they're looking at. They're looking at what we had going on in 2019 and what we have going on in Q1 of 2020. And so those are kind of the two periods that you want to match up against.
Mark, this is Brent. If I could add something here.
Yep.
One of the questions, and I'm a reformed accountant, so I don't know if I've gone up or down from the accounting profession. Thank you. One of the questions that has been paramount in my mind is on all of these calculations, are we on a cash basis or are we on an accrual basis? And we were hoping to get clarity, and I'd love to hear your perspectives, but from my reading of the form it's very clear it is both. And being an accountant, that's not clear at all to me. It really needs to be one or the other, but the form says it's either incurred or paid. So you really have the benefit of the doubt. And I think that's one of the overriding messages we want to get across to everybody today is the SBA is trying to give you as recipients of the PPP the benefit of the doubt. So big picture, what are these calculations trying to get at? And that's what we're trying to look at as a bank. The SBA wants you to do two things. They want you to maintain the salaries of the people you had on your payroll, and that's why they're looking at last year's salaries. Then they want you to maintain the head count. So you have a potential reduction based on salary dollars and also on FTE. So those are the two things that all these minute calculations that Mark is walking through are trying to get to is, were you able to maintain those? And if you can answer yes to both of those, in all likelihood, you're going to have a substantial, if not all, or total amount of your PPP loan forgiven if you also have the other allowable expenses.
Right.
And Mark, there's a number of questions on, did you have something you wanted to add?
No, go ahead.
There's a number of questions around self-employed and how this changes. So if I'm self-employed, or if I'm let's say I have a business, but I'm the only, I'm an owner operator and I'm the only one, what changes there?
Maybe I can take that, Mark. So let's assume a very simple example where this independent, let's call them an independent contractor, makes over $100,000 a year. Therefore, they're limited to the $100,000 a year. They're able to get forgiven on the payroll portion 8/52. And here I go again, dumping into the weeds, but 8 weeks, right? Eight weeks is the period. over 52 weeks in a year, they automatically get forgiven that portion of the loan, irrespective of them paying themselves or not.
All right, Mark, where do we want to go? So we talk this is deep. This is deep stuff. But the risk
Yeah,
we got,
and I'll bring this back to the application, go
Yeah,
high
go back to
level
the
here so we
application.
can, and I'll try to do a more clear scenario of just, we kept everybody employed, let's see what happens. And so on the application here, all that we're doing is filling out, as you can see, the employee's name, identifier. We're listing their cash compensation for the 8-week period here. And we just need to do that calculation through the spreadsheet. And listing out their average full-time equivalent during that 8-week period too. And maybe now's a good time to talk about what a full-time equivalent is and how to calculate that.
let's talk about that, because this was very uncertain the last time we got together on this topic. What is the calculation for full-time equivalents, and why does it matter?
So the easiest thing I've found to figure out the full-time equivalent is what they want to know is an employee that let's take this down to their hourly weekly amount. How many hours per week did they work? And if we can get it to how many hours per week did they work, we're going to divide that number by 40, and we're going to cap it at 42. So we're not going to include anybody that has 50, 60 hours. We're going to cap this number at 40, and then we're going to divide by 40. So everybody that's a full-time employee is 1 FTE or full-time equivalent. Anybody that is less than that, a 20-hour person, for example, would be 0.5 FTEs. And the reason that they're looking at these and want to get everybody equivalent, so we're comparing apples to apples, is that they want to look back at different periods and see what is your head count done, and let's make this equivalent. So let's not just say we had 75 employees and now we have 60 employees, because we could have had, when we had 75 employees, had 50 part-time and 25 full-time, and that mix could change. And so we want everybody, just the number of hours divided by 40. And you could do it high level too. Well, not per this application, it wants it per individual, but you could combine everybody's hours and divide by 40 and give you the total FTEs. So that calculation will come in handy as we go, but that's one of the things you're going to need to fill out on the application is the FTE per employee that you paid. As you can see here, there's not a lot of room to list everybody if you have more than the 7 or 8 that they have here. So most likely you're going to be doing this on a spreadsheet, such as the one that we're going through today. And I kind of talked about the last column on here is the hourly wage reduction. And that's if you did not pay them the equivalent of what you were paying them, you've got to take a temporary, well, as we go through the application, there's a way to restore it, but you've got to take a hit on your forgiveness for reducing their wages. Another thing, if we could note really quick, the people that should be listed here are their principal place of residence is in the United States and they're making under $100,000, or they were not employed by the borrower at any point in 2019. These also do not include independent contractors. So anybody that you're not paying W-2 wages to and is getting paid as a 1099 contractor is not eligible for your PPP loan because they're eligible for their own. And so don't list any independent contractors here. And so that gets us here. So you've kind of seen the spreadsheet, how we would come up with these numbers here. The second one is the people that earned over $100,000. And it's going, like I showed on the spreadsheet, is going to limit them. So that gives us box 1, 2, 3, 4, and 5 for our, let's scroll up here, for what they have here called the Schedule A of the PPP. And so that we've got all those lines filled out. And I'm going to go back over here to the spreadsheet because the spreadsheet itself actually has Schedule A in here. So you can see the line numbers here, and you can see how it's populating as we fill out this information, the information you need for Schedule A on here. So I think we've hit these 2 areas here by just filling out the tables at the beginning. Now, the non-cash compensation payroll costs during the covered period also include, in addition to payroll, include your employer portion of health insurance benefits. So what I would suggest is getting your health insurance bill, look how much you paid per employee, and then, and this would be 2 bills, right? So it'd be maybe your May and June bill. Look how much you paid for employees, and then look how much you charged your employees, and just take the difference there. And so this one, again, is the guidance is still up in the air on this, but can you just take 2 bills and do that with 2 bills, or do you have to cut it off in the 8 weeks? Very vague on the guidance for that one, but for right now, we're just recommending taking 2 months worth of bills, your May and June bill, and figuring out how much you paid after employees reimbursed you. Second thing in here is the employee retirement plans. What was the employer contribution, not the employee contribution, but the employer contribution for that. And then the last line on here is the local, state and local taxes. So your SUTA that you've paid per employee. So again, calculations you're going to have to do before you get to this spreadsheet. Also, let me go back over the schedule worksheet. So I'm going to assume that we did not have, I'm going to go high level here and go back to this, this sheet here, which is the forgiveness calculation. So we got our payroll costs that are calculated there. This is how much we, oh, I didn't do the rent calculations, the non-payroll cost tracker. So here, we're going to list the payroll, or sorry, the non-payroll costs that are forgivable, which are these things up here. You've got your mortgage interest, if you've got a mortgage, any other interest on leases as well, and or your rent for the property that you're in. And so generally you're gonna have 2 monthly payments there for each of the, or for your rent. And then you move over to the business utility payments. And this, I really like this spreadsheet because it kind of opened my eyes as to what is included in utilities. Originally just thinking gas and electric, but we could include transportation, electricity, gas, water, phone, internet. So all these things could be included in our forgiveness amount.
Let's talk about that real quick. So they've specified that what the definition of the utilities are. If you go back to the application, page 2, it spells that out at the bottom of page 2, eligible non-payroll costs. So this we'll go to the source right there. So if you have any questions, here's your eligible, this is the type of utilities. One of the questions that came up was, what is transportation?
Transportation, I would assume if you're paying a stipend for UTA, that kind of thing, would somewhat be included in utilities. I was kind of confused on transportation. Well, maybe if you run a shuttle, if you're at Thanksgiving Point, your company runs a shuttle, that kind of thing. I would not say it's taking trips, airline flights, that kind of thing. Not that anyone's doing that. But.
So that one's still a little bit, could use further verification.
Absolutely.
Yeah, and that's the thing I would say to everybody is we know a lot more. There's still a lot more that we don't know. Let me kind of sidebar on that. Brent, as somebody who's going to be processing these applications, how are you? Where there's gray area, what is a bank going to do?
Put it this way, when there's a gray area, we're going to do our best to give the benefit of the doubt to the PPP borrower, as long as there is supportable information that we can audit to. And that's where, as you put together your PPP application, think about creating an audit package, taking it to subtotals, and then taking those subtotals to your different payroll reports and even to bank records for your largest disbursements. So you want to create a package that's very easy for your bank to be able to audit, because your bank's going to want to audit it because ultimately the SBA may want to come in and audit it. We have a great deal of discretion to be able to rely on certifications. In fact, there's some discussion that the banks will not even have to keep your Schedule A's with all of your employee information that Mark was just walking through. But at the end of the day, it's very important for you, when you're requesting forgiveness, to be able to have a supportable package saying, this is our good faith effort to complete the application. I think the SBA is going to go in knowing that there's a lot of confusion out there. So if you go in doing your best to make a good faith effort, I think everybody's going to give you the benefit of the doubt. But the documentation is the key.
A couple other questions are on these topics that we just hit that I saw. Timelines. What? Let's say the early PPP loans will be hitting their 8 weeks here at the beginning of June. When do they need to? What's the last date that they need to apply for a forgiveness under the current rules?
So it's cut off at June 30th right now, but that's just their cutoff for the look back period. Right now, I don't think we have a deadline for forgiveness, and maybe Brent, you can elaborate on that. But I have not seen a deadline for applying for forgiveness. But that also brings up a good point: is that the SBA and Congress could push off that deadline as far as they want, as they get everything straightened out and answering all these questions. They could say, we're not going to accrue interest on your loans, and we're going to have till July 31st now before we even start accruing interest. So the forgiveness portion, I don't know exactly when the deadline is to apply for it.
And my understanding is it's generally 2 months after the initial 8-week period, you have to apply for forgiveness. And I also want to address, there's a lot of questions about whether interest accrues or it does not accrue. It's accruing at 1%. The interest is deferred, but the interest is accruing at 1% from the day that you receive the loan. No payments are required to be made, but yet it is accruing, is the way we are handling PPP loans.
Yeah, and that interest is eligible for forgiveness. So even though that interest is accruing from day one, under the right scenario, you can have that interest forgiven as well as the original principal.
Some other questions related to the non-payroll expenses. Home-based small businesses, could you apply home mortgage interest and utilities?
Well, from our firm's perspective, that's an open issue. For example, if you have a home, not just the utilities, but what if you have a home office? Can you somehow pay rent to yourself and deduct that and allocate that and a portion of utilities? I'm not aware, others may on the panel, but I'm not aware of any guidance on that issue.
Correct. I'm not aware of any definitive guidance either.
I mean, if we look at it from a tax perspective, Shane, talk about this from tax deductibility. I mean, that's a pretty good, that might be a framework that could influence how we look at these things.
Yeah, if you have a home office and you're deducting that, and there's a lack of guidance, I would hope the bank would, as Brent has pointed out, I hope the bank would give you some latitude in allowing you to apply some of that towards the forgiveness, because it is allowed as a deduction. If it weren't being forgiven, it would be allowed as a deduction on your tax return, as would the allocation of utilities to that portion of your home office.
One more question, and then let's dive back in. Based on what you said, Brent, that you've got right now under the current rules, you got 2 months. This is a moving target. There's a lot of ambiguities. You're not going to have to pay on the loan for 6 months. Would it be fair to say, take your time in submitting your application to let some of these issues settle?
I think that would be a smart move, considering it seems like every week we get more and more documentation requirements, as well as it tends to be moving in the borrower's favor. So I think I would, if I were in the shoes of being a PPP recipient, I would take as much time as possible. I'd be gathering the information, gathering the payroll reports, building my books and records to be able to support the calculations. But definitely, time is your friend here. It doesn't hurt you to wait. So see what evolves over the next few weeks.
Yeah, because June's going to be crazy as applications will start for forgiveness will be able to be submitted. We're going to see a flood of updates on these questions. The other point that I just want to highlight, Brent, because I've seen some questions like what information do you need to provide? I'm going to reinforce what Brent said. Everything. Like if there's a number make sure it can be backed up, right? Either in calculation or in documentation.
And more so, not so much even for the bank, but for yourself and your own protection, right? I mean, ladies and gentlemen, you're going to have to certify here to both the SBA and to the bank. And what you want to be careful of is, bank fraud. That is a very serious penalty. So make sure that anything you do in good faith and you have the supporting documentation. I don't say that to scare anyone, but rather to be very realistic that you need to have good supporting information. And there is so much ambiguity and uncertainty. I think everybody's going to give you the benefit of the doubt, but you do need to have that supporting documentation and audit trail for how you came up with your numbers.
And Mark, you've jumped here into the application. It shows exactly what they have stated here: bank statements, third-party payroll service reports, bills, receipts, canceled checks. So that you just basically want to back up your numbers. If you're submitting a number, where it should be able to tie back to a statement, a report, a receipt, a calculation, right?
And what's interesting also is that in addition to backing up with documentation, payroll, FTE, and non-payroll to the bank, you also are encouraged to keep your own set of additional documentation backing this up in case of an audit, I assume. And it's got a list here of what they want to see, how you came up with the calculations, that type of stuff. So the spreadsheet you used to generate the numbers you put on the spreadsheet. I'm sorry, on the application.
Okay, why don't we jump back in where we interrupted you, Mark, and let's kind of build out the rest of this application.
Okay, Mark, before you jump in, maybe this is an opportunity to mention the planning. Let's think about some things that we can do by way of planning. Now, we do not want to play the PPP lottery. Stephen and I often talk about this. So you don't want to commit bank fraud, and you don't want to put yourself out on a limb. But the way that the current application is written would appear that if you're on a monthly pay cycle, for example, and you elect not to take the alternative covered period, meaning you take the period that begins on the date that you receive the loan, there's the possibility that you could get more than 8 weeks of payroll included in the time period. And that's simply because, let's say that you pay monthly and you get the loan on the 1st of May and you pay your April payroll on the 3rd of May. So according to the way the rules are written now, you potentially could deduct your payroll on the 3rd, and then you could deduct your payroll for the following month, and then you could accrue your payroll for the rest of the 8-week period. And I guess there's opportunities to do the same thing for rent and other areas. Again, not proposing that you push this to the limit, but just things to talk about and to think about as you're analyzing your options. Back to you, Mark.
So what I have here is, again, the application front page, or the top application summary. It shows our payroll costs that we entered. We got a $75,000 loan. It shows the payroll costs that we have, and additionally, in addition to that, it has our rent and our utility payments for total eligible costs of $69,466. Total salary, hourly wage reduction. So now, as Shane pointed out, we're going to move into how are we going to reduce this amount, if anything. The first thing it's going to do is take off, and that's what I was showing on the other spreadsheet where we reduced a couple of people's wages. It takes off that amount from our 69,000 and gives us a new subtotal. Then it's going to look at our full-time equivalent. And this, we'll get into this calculation because I'm sure there'll be lots of questions on that. But if our full-time equivalents, as we discussed with and define those, drop and we don't restore them, then we've got to take a cut of, in this case, about 7-8% to the subtotal here. So we take that cut and come up with a modified total. And so then this is where it lists the three totals, subtotals that we can choose from. And well, we don't choose. They choose the lowest one as our forgiveness amount. We either chose what we came up with all of our calculations. We choose have the option of the loan amount. So if all of our payroll costs exceeded our loan amount and our non-payroll costs, and that amount turned out to be $80,000, we couldn't obviously get forgiven more than the 75. So that's where that one comes in. And then the next one is, if all of our payroll costs were not 75%, then it reduces it down to, okay, of the loan amount of what you spent for the loan, 75% of it has to be payroll costs. And that's as of right now in the legislation. And so if we didn't hit that and we spent a lot more on our rent and utilities than payroll, then we would have that lower amount to choose from. So in our case, it would be $62,000 as the forgiveness amount. And then if we received an EIDL, $10,000 or $1,000, that would come off. You can see here, I can plug that in. That would come off of our forgiveness. So they're saying you got $10,000 already, keep that, but your forgiveness is reduced by that amount as well. So that's just a nuance there. And then it will show you the remaining loan balance after forgiveness. So those are high level the calculations that we're trying to get at. I think that the things that we can dig a little bit more into is the full-time equivalent quotient if we want to.
There's one or two topics I want to dive into based on some questions that I'm seeing. The first is, and this came up earlier, so let's talk about it. If an employee quits, am I going to still be penalized? This is a complex one. So let's talk about it. Employee quits, or I think it's the same scenario. You furlough them. What we're seeing is you're telling people, hey, you got your job back, come on back. And they're like, I'm getting more on unemployment. I don't want to come back. What happens there?
So Stephen, maybe I'll take a stab at this one, and Mark and Shane can chime in. But twofold. So if an employee quits and you try to get them back and they say, no, thank you, I would rather collect unemployment, or likewise, if someone that you've let go and you want to bring them back to be able to get things going and utilize your PPP funds, and they say, no, thank you, I'm making more on unemployment, what can you do? And the SBA addressed that in that if you have a documented written offer for that employee to come back to work for you, and then likewise have a documented rejection of your offer, then you can adjust your FTE calculations. So the portion that would be a reduction of your forgiveness amount related to FTE is an exception is made for that, but to my knowledge, it still doesn't cure your issue as it relates to payroll dollars. So in essence, there's a double penalty that we've been talking about. If you have reduced FTE and reduced payroll dollars, your forgiveness will be reduced. That is a cure for a portion of it, your FTE portion, but it is not a cure for your payroll dollars. Shane and Mark, do you want to chime in on that?
No, I think that's accurate. I do think that employee ought to probably be reminded that if they forego a job, they're probably not eligible for unemployment, which I guess is an issue for them to take up. But just to emphasize the point, yes, you get a pass on the full-time equivalent reduction calculation under the safe harbor rule. If you have documentation that you made them an offer, they declined it, etc. But that unless you replace that employee, it doesn't help you by way of getting loan forgiveness. So in the ideal situation, you would want to replace that employee and then apply those dollars towards loan forgiveness.
Awesome. The other question that I've seen, and this has come up repeatedly, and I would argue this is people that want to maximize their loan, bonuses. let's say somebody says, hey, I am under the 15,385 threshold. I want to, let's say I want to just give some love to my team. This is a little bit of a gray area still, but what is the thinking around bonusing during this time frame?
I can tell you what we're telling people as a firm, and that is try to stay in the normal, try to stay in the lanes of normal course of business. If you look back over the last several years and you never gave bonuses during that period, and now you're giving these unusually large bonuses, that might be a bit problematic. But that's more of a common sense rule than I think than anything that I've read. But the application, again, as Brent pointed out, is this weird modified cash accrual method that allows you to deduct both things that were paid and things that were accrued.
I guess the only thing I would chime in on that is be very, very careful for your highly compensated employees. Those over 100,000, that is a hard cap. That's both payroll dollars, normal salary, and bonus. And if you're going to give unusual bonuses to employees that are still making under the 100,000 on an annualized basis, including bonus, I think there would be very little criticism for doing that. I think Shane is right. Stay in the normal course of business, but if you're going to do it, bonus those lower paid employees, I doubt there'll be much pushback on that.
Another question, assuming, so you go through this calculation, you've got a surplus balance, your loan amount's reduced, then that's just treated as a 2-year loan with a 1% interest rate that you're just going to pay off over that 2-year period starting in it, but it doesn't start for 6 months. Is that correct, Brent?
That is correct. It starts 6 months. Your payment starts 6 months after you take your initial draw on the loan.
Gotcha. Okay. Hit some of those key points. There's obviously a lot of places we can go from here. We can dive deeper. Tanner, John, are we seeing any other strong questions that from the audience that are kind of an aggregation of interest in a certain area? This stuff gets deep fast, so we want to try and cover the most pertinent issues.
Yeah, I do think, Stephen, as we're waiting to hear from John and Tanner, that Mark ought to do just a high flyby and a minimum of the full-time equivalent reduction calculation and let people see.
Let's do that.
Some of the mechanics of that.
Okay, let's dive in there while we kind of aggregate the questions.
Perfect. Okay. Full-time equivalent, buckle up. So they have a whole sheet dedicated to evaluating your full-time equivalents. And so one of the things, and the application does as well, but one of the things it's looking at is, okay, of the people that made less than 100,000, let's during the 8-week period, what was your full-time equivalent there? And then people over 100,000. The application has those in separate spots. So that's why this sheet has it in separate spots as well. Then it's going to say, okay, we need to compare this to a whole bunch of stuff to figure out if you're going to have to take a penalty on the reduction on the reduction of FTEs. And so it's looking at one of 2 payroll periods here that you have to calculate your FTEs to compare against. So think of this as a numerator and denominator scenario. Your numerator is going to be what it was during the 8-week period. In our case, there were 6 full-time equivalents. Now it's going to say, okay, what were the average number of full-time employees on payroll employed by the borrower between February 15th and June 30th, 2019. So this is back last year, as we were talking about. There's a whole bunch of stuff we're comparing to, but this one's kind of the equivalent period that we're looking at last year. And so you'll need to go through and pull those reports and see, again, try to get it down onto a weekly basis and then divide by 40 to get how many people did I have in that date range. And that in this instance, Dunder Mifflin had 8 employees then. The lower the number here, the better. And we get to choose, this is the one we get to choose, and obviously choose the lower one. what period we're going to look against. The other period that we could look at is January 1st, 2020 to February 29th, 2020. What were our full-time equivalents then? And if we're seasonal, then we can choose a 12-week period. We can say, okay, we have the option to choose a consecutive 12-week period sometime between May 1st, 2019 and September 15th, 2019 to fill in there as an optional third choice there. But again, that's only if you're seasonal. So what we do there is that we compare and then say, okay, we were at 6, but our lowest of these 2 periods, we were at 6.5. So that's why we took the, if you remember back on the application, we took the 7% ding on that because we did reduce by 7%. If I were to well, I won't show you here because it is on the other page. But so now that we've determined that we're going to take a reduction because of our look back period, we have the chance for a safe harbor on the full-time equivalents. Basically, can we get this back up to where it needs to be by June 30th? And if we did it by June 30th and got our full-time equivalents back up, we do not have to take that reduction in forgiveness. So the safe harbor here is looking at a couple of different periods as well. February 15, 2020 to April 26, 2020. And again, that's before the PPP loans got funded, but when COVID started. So what were we at there? We were at 7.5 at that point. Let's look at another period then, the pay period that included February 15, 2020. What were we at that specific point, right when COVID started? And it will look at that and then say, okay, you right here, and I need to remember, you experienced a loss here of FTE, and that's an organic loss. It's basically saying before you knew there was PPP and you got PPP funds, you experienced an organic loss, so you are eligible for some forgiveness if you get that back up as of June 30th, 2020. And again, you have here June 30th, 2020. You can see if I put in that I got back up to 7.5 and go back over to the calculator, I now don't have any more reduction for forgiveness. I'm at 100% that I can times that by, so I don't have any reduction in forgiveness if I was able to restore full-time equivalents by that date.
Okay, need the Excedrin. My head's hurting again.
Yeah, it's fun. It's fun stuff.
I want to kind of, I've got a couple of questions coming in that are getting back to the sole proprietor, self-employed. And these are kind of, these are a variety of questions. So sole proprietor or self-employed, and I'm paying by distributions. Does that count as payroll?
It's a little complex, but I think I can answer it without giving you another headache, Stephen, or at least a big headache. Distributions out of a C Corp and an S Corp are not eligible for PPP. The distributions that are eligible out of a LLC, for example, let's say taxed as a partnership, or a sole proprietor, are any amounts that are subject to self-employment tax. Those numbers appear on Schedule C of your tax return. So if you go to Schedule C of your tax return, line 31, you take that number, and that becomes the basis upon which your loan is calculated. So let's say, for example, that number is $100,000. That means that you would take $100,000, right? Divide it by 12 and times it by 2.5, and that would give you $20,833 of loan for which you'd be eligible for. I mentioned just a moment ago that you automatically get forgiven for 8 out of the 52 weeks. You automatically get forgiven for $15,385. So that means you have a remaining amount, of 5,000, 5,500, I'm just rounding, $5,500 to spend on non-payroll related items. All right, Stephen, help me unpack that a bit.
I don't know. My head's hurting.
So the key is really go to Schedule C, line 31, and that's the number from which you applied. And then forgiveness is, the 8 over 52 of that number, and the rest has to be applied towards utilities, interest, other items.
So here's a really good question. Silicon Soaps, I'm assuming a lot of tech, and a lot of times in early stage, as an owner, you're not taking a lot of pay. Been there, it sucks. Let's say you weren't taking pay before, you got a loan application because you had, you're paying your staff, and you want to top off that application, and you want to either pay or bonus the owner who wasn't taking pay pre-PPP. What's going to happen there? Is that going to be allowed? Is that going to be, how are you going to approach that if you as an owner were not taking payroll and now you did during this 8-week period?
This is Brent. I'll jump in on that one. I think that's totally allowable, subject to the $100,000 compensation per employee. So if it's normal payroll and you decide to include yourself because of the services you're providing the company, that would be allowable.
Awesome. Obviously be smart. I saw a great story the other day about some reality TV guy who went out and was buying jewelry and spending them. And I don't even know how they found this out, but he must have been posting to Instagram or something about all the stuff he was doing with his PPP loan. And they already busted him down even before he applied for forgiveness. So I think Shane and I are, we're a more conservative bunch, but we're going to say, use good judgment, like with how you're applying your money. Don't be running around in your new Tesla and saying, hey, look at my PPP Tesla. That's the kind of stuff that's going to get you. Those are extreme cases, and you'll probably see those. I imagine SBA, the Fed, they're going to look for those blatant abusers and try and make a show of them. If you're trying to make good judgment, when in doubt, consult with a professional. We're running out of time here. What other questions? I'm looking through this list of questions. There's so many.
I guess one other point I'd like to make is, while this is the application that the SBA has put out, most banks that you deal with will create their custom online application, if you will, for forgiveness. It will certainly be getting at the same information, but we're all doing our best working with software vendors to make this as intuitive as possible. And there have been some great demonstrations of some spreadsheets that are out there. So use those spreadsheets to prepare yourself. But I think everybody will have a little bit different experience. I don't think there'll be very many banks that ask you to just upload the PDF of the SBA application. In all likelihood, it'll be an interactive form with your bank.
Here's a good question. And I remember seeing this, and I think we talked about this in the pre-call. Can owner benefits be applied to PPP forgiveness? So an owner has health insurance. Do they get to count that towards forgiveness?
I would
very little guidance around the health insurance and the employer portion of retirement. So I would say it is, because the company paid it on behalf of the employee.
And I would agree with that, so long as the owner is on payroll. But if the owner was not on payroll, then you would not want to put it in the owner's benefits.
Okay.
Hey, Stephen, this might be the last question, but Travis was very helpful in the chat as which is, how long would you recommend to set aside in terms of time for the PPP forgiveness application? And I think in addition to that, we see that there's a lot of questions still here unanswered. where would you recommend people go for help in trying to find the answers?
Okay. This is the first question, how much time? I think I'm going to give you my opinion, and Shane and Mark, feel free to jump in. I think it's kind of like your tax return, right? It depends on how complex your business is, how complex your situation is. The more complexity, the more employees, it's going to be, it's going to take a lot more time, right? If you've got a simple situation, you haven't had to cut employees, you only have a few employees, you haven't had to cut pay, it might not be a very difficult thing to do on your own. But if you run into those situations where you've had employees who you've had to cut, where you've had to cut pay, it can get pretty gnarly in a hurry, as we saw here. Shane or Mark, do you guys want to add to that?
Yeah, I'll give it a shot. So our clientele during the application phase, for the most part, we're able to get through that with phone calls and periodic help. We're finding that through the forgiveness portion of this process, it's a significantly expanded effort that they're asking, not only of us, but of the people within their organizations. It's hard for me to guess what that factor is, but I don't know, probably a factor of 5 or 10 to the effort that they put into the application process. And if you can get through the full-time equivalent and the wage reduction issues, I agree with you, Stephen, that for the most part, you can glide through the process. But if you get hung up on either of those two categories, you're probably going to need some help.
That kind of brings us to the second question, and maybe Brent, if you guys are going to be up to your necks in processing applications. If somebody says, I need help, what are you going to tell them?
Yeah, well, the good news is we have a little time to process all of these applications. We will be inundated. But one thing I would remind everyone is the SBA has given all of the banks a great deal of latitude in terms of reviewing these applications and making the determinations. Ultimately, it is your bank that provided the PPP loan that will make the determination of what is sufficient documentation and to audit the calculations. So when you're looking for documentation, there's all kinds of great websites, the SBA site primarily. But make sure you're in contact with your bank that you got the PPP loan from. For example, we have a website dedicated to PPP loan forgiveness, and we update Q&A all the time on that page, trying to provide as much information as possible. Knowledge is power, and to the extent we can get our borrowers the information and let them do the calculations correctly up front, we're all better off. But as we know, this is a moving target. And what we've shared with you today may well change tomorrow with the new Q&A that comes out. So it is very important to stay abreast of that information. And I would follow your bank very closely.
Awesome. And just to reiterate your point, you do have to apply for forgiveness with the bank you got the loan from.
That is correct.
Okay. And obviously, it might be a little self-serving, but like if it's really overwhelming, get an accountant. This is what we do. Not every accounting firm is doing PPP stuff, but there are those out there that are immersed in the PPP and can provide assistance as well. All right, I think this takes us to the bottom of our meeting. I know there's probably a lot of one-off questions that we didn't answer. I would say, like Shane, you guys have provided a lot of free resources to the community. You guys are doing webinars, you guys have lots of documents and videos and stuff. So that's another place that people could go to for answers in addition to like your bank. Anything you want to say there?
Yeah, so go to squirecares.com, and there are a lot of free resources. On Tuesday of next week, Squire is holding a forgiveness seminar, but we've decided all we're going to do in that is just answer questions. So it could be as short as 30 seconds. So if you do have questions that didn't get answered today, you can join Tuesday at, I believe it's at 11 a.m.
Awesome. Okay, with that, we'll wrap that up. Thanks everyone for joining us today. And I know it's been a lot, but you can do it.